Imagine waking up tomorrow to discover that the rules of money you've lived under your entire life were never truly neutral, never purely democratic, and never fully under the control of governments you vote for. Imagine realizing that behind central banks, stock exchanges, and sovereign debt sits a small, tightly connected network of families and institutions whose influence stretches across centuries. Not a cartoon villain pulling strings from a dark room, but something far more unsettling. A system so normalized, so embedded that questioning it feels almost taboo. If global finance is supposed to be competitive, transparent, and decentralized, why does power keep concentrating in the same hands? That is the mystery we're unraveling today. To understand how we got here, we have to step back before stock tickers, before central banks, before the word globalization even existed. Modern finance didn't emerge fully formed. It evolved through necessity, war, and opportunity. In medieval Europe, money lending was risky and often restricted by law or religion. Kings needed funds for wars, exploration, and administration, but taxation alone wasn't enough. This vacuum created a new class of power brokers. Merchant bankers who could move money across borders faster than armies could march. Families who mastered trust, accounting, and networks gained something more valuable than gold itself: credibility. Cause and effect begins here. When rulers borrowed from these families, they became dependent. Dependence turned into privilege. Privilege turned into permanence. The same houses financed monarchs on opposite sides of wars, not out of ideology, but out of survival and leverage. Over time, this arrangement quietly rewired power. Political authority still wore crowns, but financial authority began to sit elsewhere, protected not by armies, but by contracts, debt, and reputation. As nation-states grew, so did their appetite for capital. The Industrial Revolution supercharged this process. Railroads, factories, and global trade required massive upfront investment. This is where finance shifted from being merely supportive to being structural. Banking families and later financial institutions didn't just fund growth, they decided which growth happened. Entire regions rose or stagnated based on credit flows. The effect was subtle but profound. Economic destiny became increasingly shaped by access to capital rather than innovation alone. By the time central banking systems were formalized, this concentration had already occurred. Central banks were presented as stabilizers, guardians against panic and inflation. To be fair, they did reduce certain kinds of chaos. But they also institutionalized a separation between money creation and the public. Private banks gained the ability to create money through lending, while central banks stood behind them as lenders of last resort. This wasn't a conspiracy. It was a design choice. The cause was fear of instability. The effect was moral hazard and consolidation. As decades passed, smaller banks were absorbed, merged, or eliminated during crises. Each financial panic became a filtering event. Those with diversified assets and political connections survived, those without them didn't. By the late 20th century, global finance had become a web of too-big-to-fail institutions, often managed by people who rotated between government, central banks, and private firms. The families of the past had evolved into dynasties of influence, foundations, and asset managers. Names changed. Control structures matured. Then came the breaking point, repeatedly. The Great Depression, the collapse of Bretton Woods, the 2008 financial crisis. Each time, the pattern repeated. Excess leverage built up during booms, crashes followed. Governments intervened to prevent total collapse. Losses were socialized. Gains largely were not. The justification was always stability. The effect was always consolidation. After 2008, a small number of financial institutions controlled an unprecedented share of global assets. Some asset managers now hold significant stakes in thousands of companies simultaneously, blurring the line between ownership and influence. The fallout of this system wasn't just economic, it was psychological. Trust eroded. People sensed the game was tilted even if they couldn't articulate how. Wages stagnated while asset prices soared. Housing, education, and healthcare became increasingly financialized. The cause was cheap money and financial engineering. The effect was inequality that felt systemic rather than accidental. Attempts to fix the system followed every crisis. New regulations, new watchdogs, new promises. But the fixes often failed for a simple reason. They addressed symptoms, not structure. Capital requirements were raised, but loopholes emerged.
Ow!
Risk was moved off balance sheets, not eliminated. Political cycles were short. Financial strategies were long. Over time, regulation itself became a barrier to entry, protecting incumbents more than challengers. What was meant to restrain power often ended up reinforcing it. Now look at the present. The language has changed: algorithms instead of ledgers, digital currencies instead of paper notes. But the pattern remains. A tiny fraction of entities control a massive share of global financial flows. When markets wobble, central banks intervene within days or even hours. Liquidity appears instantly for financial institutions, while ordinary people wait years for relief. This isn't about secret meetings in smoke-filled rooms. It's about incentives embedded so deeply that outcomes are predictable. Here's the shocking part. Over and over again, history shows that financial power concentrates fastest during crises. Volatility isn't a bug of the system. It's a feature that rewards scale, patience, and access to credit. Those who already have capital can buy distressed assets cheaply. Those who don't are forced to sell. The cause is asymmetry. The effect is accumulation. So what does this mean for you? It means that the story of global finance isn't just about numbers, it's about power paths. It's about how decisions made centuries ago still shape who gets rescued, who gets blamed, and who gets forgotten. It's about how the market often functions less like a free arena and more like a carefully managed ecosystem. If there are 3 takeaways to leave with, let them be these. First, financial systems are not neutral. They reflect the interests and fears of those who design them, and those designs tend to persist long after the original context is gone. Second, crises are not equalizers. They are accelerators of existing trends, often deepening inequality rather than correcting it. And third, transparency without structural change is not reform, it's theater. The warning is not that a few families or institutions are evil masterminds. That's too simple and too comforting. The real danger is a system that concentrates power without accountability. While convincing the public that nothing else is possible, the open-ended question is this: if financial rules are human-made, why do we treat them as laws of nature? If this video challenged the way you see money, power, and history, take a moment to engage. Like the video so it reaches more curious minds. Subscribe for deeper explorations into the systems shaping your life, and share your thoughts below. Because the first step in changing any system is understanding how it actually works.